Hi, thank you for joining us today for our panel, Private Equity, Hedge Funds and REITs, a mutually beneficial ecosystem, competing models, and post-COVID implications. I'm Lauren HOCHFELDER. I'm the Deputy CIO and Head of the Americas for Morgan Stanley Real Estate Investing, which is Morgan Stanley's direct real estate investing business. I am thrilled to be joined today by three incredible colleagues and leaders in the real estate business from both the private and public sides. And to start, let's briefly introduce ourselves and our businesses. Jim, may I start with you?
Sure. Thank you, Lauren. Well, good afternoon, everybody. I'm Jim CONOR. I am the chairman and CEO of Duke Realty. Duke has been around for about 50 years. We've been publicly traded on the New York Stock Exchange for 27 years now. Since 2017, we have focused exclusively on the industrial and logistics sector. We own about 165 million square feet around the country in the top 20 markets, with an enterprise value of about $20 billion today.
Conor.
Thanks, Lauren. Thanks for having me. Conor Flynn, CEO of Kimco Realty. We are one of the largest grocery anchored shopping center owners in the United States. We own over 400 assets, primarily concentrated in the top 20 metro markets in the country. We have obviously been through a massive transformation of our portfolio and are well positioned, I think, for this reemergence from the pandemic.
Wonderful. And transitioning to David, who, like me, comes from the private world.
Yeah, thanks, Lauren, and thanks to everybody for being with us today. I am David Roth. I am the head of our the Ares U.S. real estate equity business. Ares is about a $200 billion asset under management alternative asset manager, publicly traded. Within the real estate group, we have about 15 billion of assets under management. The U.S. business really today consists of two strategies. We have a line of opportunistic vehicles. We're on our third vehicle, and then we have a line of value add vehicles, of which we're on our 10th vehicle. I'm excited to be here. I've been to many of these. I started my career long ago at Wachtell, Lipton, Rosen and Katz, so I've spent time with some of the folks who have put this together for a long time and have been coming for many, many years. So excited to be on the panel.
Well, thank you all so much for being here today. So starting with the title of this panel, it touches upon the myriad different flavors and formats of institutional real estate investment, different ways for institutional investors and frankly retail investors to access real estate exposure. So thought we could start there. Stepping back in history, I think 20 years ago, the industry was predominated by opportunity funds and REITs, perhaps a much simpler landscape than today. The opportunity funds all had a relatively similar profile, closed end, I think back then called vulture oriented, and largely comprised of US pension fund capital. Similarly, the REITs had a more homogeneous underlying investor base with more significant REIT dedicated institutional ownership. Hedge funds, which today are part of our panel title, were not invested in real estate in any meaningful way. Today, the landscape of institutional investment in real estate is meaningfully more diverse, and the role real estate plays in many investors' overall portfolios is much more significant. Real estate, private equity, and you heard David run through a few of the businesses Ares is in, but real estate, private equity comprises many different fund structures, some closed end, open end, risk return parameters, ever expanding nomenclature, core, core plus, value add, opportunistic, and it goes on from there, from higher octane total return to fixed income alternatives, as some categories of yield seeking investors have reduced their fixed income exposure from as high as 60 to down to 10 to 20 today. And beyond that, the institutions that were traditionally the LPs in these funds, sovereign wealth funds, corporate and state pension funds, et cetera, are now major direct owners. At the same time, turning to the public space, institutional ownership of REITs has expanded dramatically beyond the traditional REIT dedicated investors. And retail, I think, has become a much more significant part of the ownership base as well. So beyond the significant increase in liquidity this creates, how has this changing, this evolution in the ownership of our underlying businesses, as well as the diversification of that investor base, how has that affected our business? David, I'm going to start with you.
Well, I would say the obvious answer is there's a lot more different pools of capital, chasing the asset base, and from the standpoint of private equity, we're trying to set up an infrastructure where the right person is going into the marketplace and finding assets to bring back, that we analyze, and to the extent that we like the deal on a risk-adjusted basis, there's a pool of capital within the shop that has interest in owning that asset. And so that's why I think you see a proliferation, particularly on the part of the larger alternative asset managers, of having more and more different types of capital to deploy. It makes us more relevant in our marketplace if we can show up and have different solutions for counterparties, for owners, for JV partners. That makes us more relevant and makes it more likely that we're going to get sort of first and last call on a deal. So from our standpoint, it makes a lot of sense, beyond the obvious that firms like to manage more assets. So I do think it changes. I guess the gorilla in the room that you can think about is like a B-REIT and the impact that retail capital is having on a lot of markets. And I think we're going to talk a little bit, I'm sure we'll talk a lot about sort of the just the wave of equity capital that's available, which I think is backstopping, making this very different moment in time than, say, the GFC. There's just a lot more capital that is going to backstop value. So I think it's impacting the markets in a lot of different ways. I think you can always ask the question of when is the capital coming from all these pockets going to be so great that it causes bubbles, and we're constantly sort of asking that question. But for the most part, I think it's making these markets a bit more efficient and bringing the right type of capital for any given situation. So I think it's, for the most part, positive.
And Jim and Connor, how, just pivoting to the public side for a moment, how has the widening of the investor base of REITs impacted both your businesses as well as how the overall REIT universe trades?
Well, I think there's no doubt that we're dealing with a much broader universe of investors today. Connor and I spend a great deal of time at investor conferences, and the people we're meeting with today would have absolutely no interest and probably not a great deal of knowledge of the REITs. If you go back and look at history, the modern REIT era is about 25 years old. And most of the companies, when we went public and a lot of the others went public, were very small roll-ups of private and family partnerships. Most of them $500 million or less, most of them regional, small players, not very good governance, not very good disclosure, very new at becoming public companies. And consequently, I don't think REITs were very attractive to very many people outside of we'll all remember the REIT mafia. I think you fast forward today, 25 years, and there's been a lot of consolidation. Companies today have size, they have scale, they have liquidity, which you mentioned earlier. You've now got 30 REITs that are in the S&P 500. You've got companies that are national and international. You factor in real estate becoming the 11th investment sector back in 2016, opening that up to a lot of the generalist investors. And consequently, it's a much broader universe. Everybody has different interests. The hedge funds want to get in and get out. we prefer investors that are interested, in a longer hold, but recognize that, there's opportunities for everybody in the marketplace. So, I think speaking personally, it's kind of interesting today, and we kidded about this before we started, but for years, nobody really paid a lot of attention to industrial. Everybody wanted to own office buildings and malls and hotels, and they wanted to have pictures of buildings from Park Avenue and the Galleria on their prospectus and their annual reports, and nobody cared about the Inland Empire and places like that. And fast forward today, and the logistics sector has really outperformed. And I think a lot of people, I'm sure a lot of people in David's shop, are now focusing a significant amount of time and energy on all areas, not just investments in REIT, but direct investments and the fund business and everything else. It's a very, very different world from what it was 25 years ago.
Yeah, the only thing I would add is I think it's healthier, to be quite honest. I think the concentration was probably, I would say, not as healthy as the market is today. Some of the fast money, as Jim mentioned, can be a bit concerning, obviously. But when you look at how REITs have become almost like a mainstay of diversification for investors, I think the incremental investor is a generalist today, which puts a lot of, I would say, educational pressure on Jim and myself to go into investor conferences and do a bit more, work towards understanding the business and understanding how the model has changed and how, we're positioned for, as Jim has mentioned, we have tremendous access to capital. Our liquidity positions are phenomenal, and we have really significant growth opportunities. And, being a grocery anchored shopping center, I think for a while, you had to really educate understanding that, the retail store is not going away. It's not all going to industrial. And when you look at, what's changed today, I think there's a lot of takeaways from the pandemic that people have realized that last mile store that's being used as a distribution fulfillment point is all part of that education process that we've had to do.
So I want to come back to in a moment this question of distribution and grocery anchored. But before we go, there's a lot of talk about liquidity, both in each of your remarks as well as probably daily in our lives. And as we sit here today, really just past the 1-year anniversary of COVID lockdowns, and with most of the US still partially closed, several of us working outside of the office, and in many US markets really still feeling quite closed. You look across the US capital markets though, and in many places, I would say that they are none worse for the wear. In many places, and including in industrial land, asset prices are higher. And we see this both inside and outside of real estate, and within both private and public. We can look at last year's underperformers and see that mall and office REITs have recouped nearly 80% of their value. Hotel REITs, with many doors shut throughout many markets, are within 15% of their pre-COVID prices. GDP recovery looks like it's proving very strong, fundamentals strong in many places. So my question is, are asset values simply following the fundamentals? Are they simply following a very strong recovery afoot? Or is a lot of this the degree of liquidity in the system? What's fair pricing? Conor, I'm going to start with you.
Look, fair pricing, I guess, is always in the eye of the beholder, right? So I think when you look at the product type that we own, I think during the pandemic, there was a lot of concern over really what's the cash flow, right? Underwriting cash flow from the asset was the big question mark, and which categories were most impacted by the shutdowns, which ones are going to be able to reopen under capacity constraints and which ones were able to reopen quickly and recover. And when you look at where we are today and going forward, I'm really encouraged by, the green shoots that we're seeing out there, not only from the existing tenant base. I think most of the shopping center peers are all collecting, over 92% of their rents. We have 98% of our retailers all open and operating. But I'd say that the interesting thing is now that we really are starting to see a lot of transactions on the private market side, and it's at pre-COVID levels in terms of cap rates, and a lot of sub-6 cap rates for grocery anchored shopping centers in the major metro markets, which is aggressive pricing even in best of times. So to be this sort of 1 foot out of a pandemic and have the pricing snap back that quickly is clearly, I think, a showcase of not only the existing underwriting, but also the demand of what we're seeing for spaces. I think that's one of the biggest surprises to me anyways, is to see that demand is actually above pre-COVID levels at a time where we're not fully out of the pandemic yet for those locations, which is pretty remarkable.
And when you see that sort of pricing, including for any category of retail, you start to wonder what we were all thinking back in April and May when we were talking about steep COVID discounts and coming in and seeking out distress. Is there any distress to be had out there?
It was such a sharp pandemic where the downturn and then the snapback was so quick. I would say that the lenders took the approach where they would just kick the can rather than recapture grocery anchored shopping centers. And so there wasn't really the amount of stress put on the asset level to create that type of opportunity, that distress or dislocation opportunity. We were poised and ready to pounce. We thought there would be quite a bit, actually. We had aligned ourselves with some deep-pocketed investors to go on offense while the tide was going out, but nothing really of size and scale really presented itself. And now when you look at the opportunities, it's really, there's still some private owners that are in need of some capital. And that's where we're finding our opportunity is the traditional financing has not really come back in full force. And so we can potentially look at, taking pieces of deals where we normally wouldn't be able to, but provide maybe some mezzanine financing or preferred equity. And that's where we're finding the opportunities in today's market.
So you referenced sort of demand being, being higher today. And I think we've talked a lot about how COVID has accelerated numerous trends that were afoot before last March. And perhaps the most significant, or the most talked about at least, is e-commerce penetration and how that's affected, all of our shopping. I know there's not much in my home that doesn't come out of a brown paper box. And we've seen obviously the public markets in turn follow that trend. I guess as you look at the world, though, Conor, you paint a very, very positive picture as to actual in-person shopping. Maybe continue on that for one moment.
Yeah, there's some really remarkable trends. We were seeing it pre-COVID, right? Of the omni-channel experience, how regardless of where you start your shopping experience, whether it's on your phone or your laptop or your iPad or in the store, retailers have evolved to very much understand what their customer is desiring and how they service that customer to the best of their ability. And when you look at the blueprint now of what's really working, and I always point to Target as sort of being the best in class that really has outlined exactly how to be successful, is the stores are becoming what they're calling these fulfillment epicenters. And the buy online, pick up in store, the curbside pickup trends that have really emerged and are starting to take really hold now have showcased that the store can be utilized as that last mile fulfillment and distribution point, which is the most economic effective way to get the good to the consumer. If you think about, free shipping, there's no such thing as free shipping, right? You're paying for someone to drive the van, you're paying for the gas. But if you can convince a consumer to use their own gas, use their own car, use their own time to go and actually pick up the good, then all of a sudden that trade, that economic trade is actually very profitable for the retailer. And so preferences, I think, are still going to kind of ebb and flow. Some people like to shop in person, some people like to start online, but I think the e-commerce penetration side of it is not as important as what retailers are now understanding, that it's really one channel, that they have to have the ability to give the customer what they want. And you're really seeing the store being almost more valuable than it ever has been before, because it's being utilized in a way that it hasn't been before.
So Jim, if the store is more powerful than it's ever been before, how are you getting all this phenomenal leasing activity in the industrial land?
Well, look, I think it's a combination of things. I think we all recognize what the pandemic did in terms of adoption of change and e-commerce. I mean, we've all talked about it numerous times. You know, what the pandemic done is just accelerate trends, good trends and bad trends. And, you know, we've seen companies go under that we all knew were going to go under, and we've seen adoption accelerate through that. I don't think when you look at retail versus e-commerce, it's a case of simply winners and losers. Clearly, e-commerce is a big driver in our sector right now. And it's not just all Amazon, and not to take anything away from Amazon, but you've got a lot of other companies. Conor mentioned Target, you know, Target.com, Walmart.com, you know, whether it's Wayfair.com, or even, you know, companies that people think of as traditional e-commerce companies like Home Depot, who's investing billions in their supply chain. It's all about getting product to the consumer faster. The one thing that Amazon has done is they have set consumer expectations. If you can't get a product in 48 hours, you are going to lose customers, you're going to lose market share. You can get it to them in any variety. You can deliver it to their front door. As Conor said, you can get them to come into the store. You can get them to come curbside. You can get somebody like Uber or DoorDash to pick it up, whatever the case may be. But you have to have the infrastructure in place. So you have to have, the IT, the online systems to support that, to make that a pleasant, easy experience. All right. You have to offer the consumer those different choices so that they can get it. And as we've said, you can't. So all of our, growth is not just Amazon and e-commerce companies. It's traditional companies like Walmart.com and Target.com, really re-engineering their logistics and supply chain to be in a position to get products to the consumers faster, or get products to the stores faster so that they can meet that demand. Most of us can remember the holiday season was just 4 months ago. We can remember the winners and losers of the retail service providers. Everybody had great experiences with a lot of different people, but you had poor experiences. And those poor experiences were driven by a company that either doesn't have the resources or doesn't have the strategy figured out on how they're going to master this. We've mentioned a bunch of companies that have figured it out, and they're going to do just fine. They'll come out of this. They're great companies. They're really well run. They're really well capitalized. Their stores are in great shape. But we can all think of a whole host of companies that aren't going to come out of this too well. And they're not well capitalized. They don't have a strategy, and they're not figuring it out. If your strategy as a retailer is to go take something off the shelf, wrap it up, put it in a box, and go drop it in a UPS box, that's not profitable sales. That's just not. You're paying for the store. You're paying for somebody to put something on the shelf, take it off the shelf, ship it again. You've got to have a better solution to that. And Conor mentioned several of them, and there's a lot of really good examples out there. And so that's what's driving a lot of our business.
So I have a few more questions for each of you on this question of retail versus industrial, but I want to pivot for a moment to David. David, you have a broader investment mandate, right? You're not retail only, you're not industrial only. When you think about the trend of e-commerce penetration, this secular tailwind, if you will, how do you play that? How do you think about that for Ares various funds?
Yeah, so let me start by saying that we came into COVID with a long history of making investments in the industrial space, and largely industrial and multifamily. We came in with very little exposure to hospitality and retail for a variety of reasons. We believe that the e-commerce trends are very, very powerful. We have been investors in industrial and have increased that investment over time. Currently, we're if you wanted to say the way we're playing it, we're comfortable with taking development risk. We've done a lot of development over the years. We like the development cycle of industrial, and so we've been developing a fair amount of industrial space into what we think is tailwinds that are going to continue for some time. Short development cycle, an experienced group that can control costs and timing. And we think that, when you start at 4 or 5% vacancy, it's hard to get really, really hurt. Now, we know that there's a lot of people who are developing out there, but that's one way that we're playing it. We continue to look at retail, but haven't found, and if we were going to look at retail, I mean the neighborhood side of the business is certainly the best place to be. We just haven't found the situations that sort of have met our pricing parameters. But the e-commerce, growth in e-commerce, I think has got tailwinds for certainly the short and intermediate term. And what we all have to watch is how much supply is coming in, and that Amazon effect of just how much space they're taking and what happens if that changes. These are things that I think we all have to watch pretty closely. I was hoping we'd get much more of an Indian leg wrestling match between the retailer and the industrial owner, but anyway.
I know, Jim and Connor make it sound so
They're very polite.
symbiotic, like it's
They're
all
very polite.
kumbaya.
Yeah, it's all
between
kumbaya.
retail and industrial. Well, the public markets certainly don't seem.
What about
to
you,
think
Lauren?
that it's
Where do
all
you
created
sit?
equal.
Lauren, where do you sit on the spectrum? We want to hear your opinion too on industrial versus retail versus all the other opportunities out there, because you have a wide lens as well.
We do. Look, we too came into this, fortunately, overexposed, or not over, but more highly exposed to industrial and residential, which feels very good. And we're absolutely big believers in this secular reorientation. We're also doing quite a bit of industrial development here in the U.S. and on a global basis. But thinking a lot about different markets, supply chain reorientation, which markets are more geared towards e-commerce as opposed to other types of logistics needs, et cetera. And, I think certain markets for us, we invest in more on the consumer side, if you will. But look, stepping back, I think as we come out of this, it feels like there are just tremendous pent-up savings. There are, a variety of reasons. We can talk about government intervention. We can, talk about pent-up demand for services and goods, et cetera, et cetera. But it feels like both industrial and retail should benefit from a variety of these tailwinds coming out of this. And certainly, I think watching Connor in your space, watching how fortress some of the grocer-oriented locations has been, I think, really critical. I mean, what do you, to sort of take, I guess, the center of a concentric circle here, online grocer, how do you envision the future there?
So the reason why I guess we're so kumbaya is because I don't think it's like a one size fits all. I don't think it all goes industrial. I don't think it all goes e-commerce. I don't think it all goes retail. I think that's the way, sort of, as you said, everything's being reorganized. And if you have good last mile store locations, they're going to evolve to service the customer. And that's where we've positioned our portfolio, is to be really focused on dense areas where we feel like that store can evolve to service the customer in many different shapes and ways. And I think the online grocery side of it still is the lowest penetration, but you're seeing it increase. I think you'll continue to see that increase, obviously, through the pandemic and post-pandemic. But there are starting to be some stabilization points in other categories, not just grocery. You saw it first with electronics when Best Buy was marked for death. And then all of a sudden they started taking market share back from Amazon. Amazon is launching a brick and mortar, grocery store. Amazon Fresh is now open and operating, and they're obviously, nobody takes Amazon for granted. And they also own Whole Foods. So they are leaning into brick and mortar, which I think is really, really interesting, even though they're the dominant player in the industrial demand side of it. Again, on the e-commerce grocery side, I don't think it's a one size fits all. I think you're going to see people experiment with micro fulfillment centers. Albertsons announced today a strategic partnership with Google to better understand, customer preferences and utilize Google's analytic tools to help them be more of an omni-channel player, which I think is a good move. You're seeing sort of the Amazon Fresh prototype with all their tech enabled store shopping. So I think, again, as things emerge, the store will be a hybrid. And I think that'll continue to be what I think people are looking for. Certain people will want it delivered to their home. Certain people will want it to be convenient, where they can pick the time to go and pick the products. Some people don't like to wait for the cable guy to show up between 9 and 5, which is sometimes what you're doing for the package to arrive. And if you want to take control of that and go and pick it up and it's convenient, whether it's on your way to work or school, those are the types of things that I think do lend themselves to that last mile location. And I think grocery, because it's such a low margin business, is probably the most defensible part of the ecosystem of retail, where that last mile location will continue to be extremely valuable.
Can I ask, Connor, is that because when you say that it's low margin, is that because there sort of isn't a lot of cash to create technology to, you don't find a lot of the grocers moving dramatically like the Whole Foods type trade into using technology better? Because it does seem like there's a lot of, I was at the grocery yesterday, and there's a lot of time that could be saved by having the grocer do pick and pack, for everything other than the meat, or the stuff, that produce that you want to actually look at. Like, I don't think I need to be walking around a store that much.
So you're spot on, David. And I think what you're going to see is a lot of testing of almost like a micro fulfillment center in the middle of the store. So the center of store is always something that we believe at Kimco was going to change. And it was almost like a seasonal rotation of what they do within the center of the store, the grocery side. But the commodity side of the business, to your point, that's where it might be almost like automated fulfillment, where if you want to go in and get sort of your regular items that are commodity type products, they'll fulfill that bag for you. And by the time you go and pick your meat and your fish and your produce, and you go to walk out the door, that bag of commodity products will be ready to go. So that to me is what the future is going to hold. And you'll start to see that hybrid again take shape, where they're already even testing it, where whether it's bolt-on, where the micro fulfillment sits right next to a store, or in the future, if it becomes the center of store, I could see that being a very efficient model as well.
So are you seeing a lot more sort of industrial type uses in the neighborhood locations going in?
There's a lot of testing right now. There's not really a whole lot of, I would say, proven models yet. And so we're seeing people kick tires on, micro fulfillment centers, those types of uses. But the store is still, just tweaking ever so slightly. So when you go to check out, you'll start to see more refrigeration towards the exit door. And that's obviously for that pick and pack type of item, where if people want to have it delivered to their home, or if they want to come pick it up, it's ready to go. But nothing dramatic where they're sort of shifting the amount of square footage, from back of house to front of house or vice versa. You haven't seen that yet, as the store, in many, examples, some stores are getting larger because they need more items for that. You have like a certain amount of SKUs that can be held in the store, and then an unlimited amount of SKUs that are held online. And if the store wants to be that fulfillment and distribution point, they have to have more SKUs as well. So you're starting to see, a testing of all sorts of different models.
But Connor, let's talk about some of the evolutions. Some of the grocery stores today, the Fresh Times, the Whole Foods, the Fresh Markets, some of the smallers have already seeded the commodity business.
Mm-hmm.
You go into Whole Foods, you can't buy a 12-pack of Diet Coke and paper towels. You get fresh prepared fish, you get all that, which I believe you're correct, everybody still wants to pick out. Or you can get organic and specialty items. And it's almost like, they've said, look, you're either going to get that delivered from Amazon or Walmart or Target, or you're going to go to the store. And the days of, my mother going to the grocery store once a week and filling 2 baskets for a week's worth of food for the family is almost gone. It's like, I'm gonna make more frequent, shorter stops to pick up the fresh produce, the meat, the prepared foods, the salads, whatever the case may be. Now grocery stores have started to compete with the breakfast, lunch, and dinner crowd, because you go to the grocery store at lunchtime, you got 50 tradesmen in there picking up sandwiches and chicken nuggets and everything else. So I think there's really an interesting evolution that's going on today, and I think it's really going to continue, because how long can the Krogers and the Publix and the Jewels of the world compete with that?
Yeah, so you're spot on, Jim. So the highest margin part of their business is the private label side. So that's why when you go in, you see the products that are not necessarily commoditized, right? They're the O Organics brand from Safeway, for example, is a big private label brand. Costco is renowned for their private label. So that type of business continues to grow, and you're going to see it continue to be a bigger portion of shelf space, no doubt about it. And then you're spot on as well about the trend that was happening pre-COVID is that people were actually going to sometimes between 3 and 5 different grocery stores to complete their actual shop, which sounds like a lot. But if you think about it, people love to go to Trader Joe's for certain things. People love to go to Whole Foods for certain things. People love to go to the traditional grocer for certain things. And you have this wide array of specialty items that each one gets known for that people love. We do really like the specialty grocer because that trip count, to your point, is not once a week. It's sometimes 3 to 5 times a week for that stuff that you want to, you're cooking that night. You want to get organic ingredients. Those are the types of shoppers we really like because you typically see a higher cross-shopping pattern when you look at the traffic from those types of users. And that's why we really like grocery stores as a component of the merchandising mix, because we do think it adds a lot of value to the surrounding retail. And we're up to 78% grocery anchored today. We think with just the leasing demand, because grocers have had this windfall of cash, right, from the pandemic, and they are out there on the offense right now. We think we can get to 85% grocery anchored just with the leasing momentum that we're seeing in the portfolio today. And a lot of it's from those specialty grocers that'll take smaller boxes or fit in areas that, not normally are traditional sized, larger grocery boxes, which I think bodes well for the evolution of the shopping center, because you're going to see those specialty players attract people more frequently.
So with all this talk of grocer, how does cold storage fit into this ecosystem? What do you make of pricing? I mean, this is an area obviously where the public and private markets seem to be perceiving the spread between cold storage and more traditional industrial quite differently. I think private markets a lot more compressed in terms of cap rates, but how does cold storage fit in?
Well, I would tell you, we actually own a fair bit of freezer, coolers, specialty grocery space. The difference between us and the two, leaders in that sector are we're not operators. We just own the real estate. They're operators. And I think one of the things that speaks to what we just spent the last few minutes talking about is the delivery component, whether it's to the consumer's home or resupplying and restocking the stores more quickly, is the distribution network needs to evolve in the grocery stores. The traditional model is a mega distribution center that covers 6 states, and your grocery anchored, your grocery store, gets 1 semi truck a day or 2, or, depending on their volume. And that's not a particularly efficient model when you've got to ship things, from that far away to a store once a day. And so consequently, you're seeing a lot, proliferation of a lot more specialty freezer, cooler, combined space in a lot more infill areas to allow for more quicker distribution to customers and to grocery stores.
And so picking up on the infill orientation, that's obviously not just limited to grocer fulfillment. That's more broadly, as someone said earlier, I think we as consumers are spoiled that if we don't get it within 4 nanoseconds, it isn't good. How, Jim, have you seen in your own portfolio the shift towards more and more last mile?
Yeah, we've invested heavily. Over 50% of our development pipeline today is what we would call infill redevelopment. It might be brownfield, might be complete demolition, whatever the case may be. And it's really driven by the customer's demand to get product closer to the consumers. If you step back and look at the logistics and supply chain as a whole for any company, real estate is between 3 and 5% of the cost. Labor and transportation is in excess of 50% of the cost. So effectively, any one of our customers can pay me 50% more rent. And if that gets them that much closer to the end consumer, if that avails them more cheaper labor, they're winning in the end. So consequently, we've seen a tremendous amount of it. And it's not just, in the major, top 5 or top 6 cities. It's all over the country, because again, it's that Amazon effect. Everybody wants to be able to get it to the store or to the consumer that much faster.
I think we know your leasing pitch now.
Yeah.
Jim, is there a stabilization point for
There's no
Amazon?
competition out there.
Jim, is there a stabilization point for Amazon where they've blanketed, call it the last mile locations to give them, in essence, a network that gets everybody the product? I mean, they've obviously been super aggressive and are the major taker of space. Is there a point where, once that dries up, then what happens next?
Logic would tell you that there is, and I will tell you about a conversation. Amazon has been a great partner of ours. We started doing work with them 15 years ago. And we have, real estate development projects with them all over the country of, million square foot fulfillment centers and sortation centers and last mile facilities. And, after a particularly strong year with Amazon 3 or 4 years ago, I asked the guy that runs that account for us, who sits in Seattle and obviously spends quite a bit of time with them. I said, when the time is right, you need to find out, are they reaching the saturation point? So he posed the question. And I'll paraphrase and I'll clean it up. But the message was, we've worked our asses off 20 years to become, the dominant supplier, the dominant company in this sector, with something like 40% market share and year-over-year growth of double digits. If you think we're taking our foot off the accelerator for 1 minute, you are sadly mistaken. And they've held true to that every year. Now, logic would tell you they probably can't replicate what they did in 2020. They took down, you hear different reports, but through the third quarter, it was like 65 million square feet. So let's assume they ended the year at 80 million square feet, which is probably a component of 40 or 50% more than they have taken down in the last 3 or 4 years. So, maybe they go back to their normal run rate and they only take down 50 million square feet. We'll still be, the industrial sector will still be in a really good position. So, that's everything I know. Based on our development pipeline and all the opportunities we're seeing, I'm telling you, they're not slowing down.
And what are your thoughts about them? What are your thoughts about them launching like a grocery store chain?
Well, I think, and I have absolutely no knowledge, but look, they already own a grocery chain. They already own Amazon Pantry and Amazon Fresh. At some point, they will figure out how to put that all together into a better, more efficient platform. I think it's just time. David?
Jim, yeah, I'm curious. Look, there's obviously the question of, what at the margin will they continue to lease and what their growth trajectory will be. Beyond that, though, it's fascinating how efficient their boxes are, these new boxes. There's like I'm told there's like 1 million packages a day running through these facilities, or some ungodly number like that. What kind of pressure does that put on every other retailer? Like, I wonder if the end game for them is to try to sort of put the same pressure on logistics that they've done with AWS in the online space.
David, I would tell you they are clearly leaders in understanding the box. And today, the cube, they're one of the few customers of ours that looks at the cube cost, not just the square foot cost. They're the leaders in going up. There was a trend. Everybody thought the hottest thing in industrial a few years ago was going to be multi-story, and that's gone by the wayside. But doing 50, 60, now 75-foot clear buildings with mezzanines inside, and levels of those mezzanines are completely operated robotically and with material handling equipment. So they're all about driving speed and efficiency. You're absolutely right. If you have an opportunity, and I would encourage you all to tour an Amazon fulfillment center, you will see some absolutely amazing things. But they hang a banner over the shipping department. Every day they ship 1 million boxes. And you'll see some of the fulfillment centers that have been up and operating for 10 years have hundreds of those up. And you think about that. That's not pallets. That's brown UPS and FedEx and US Post Office boxes going out. And it's, it's incredible to go, to go through one of these facilities and see how fast and how efficient they operate.
I have to tell you, touring one of those facilities was even more exciting to me than, what the first mall or office building I toured, 25 plus years ago. It is truly remarkable. But with all that automation, Jim, traditionally we've thought of labor as a key driver of tenants' leasing decisions. And, I think as you sort of referenced, probably more important than rent and other factors is the availability of labor within a certain proximity of the facility. How does, with the rise of automation and robotics, is that shifting? You foresee that shifting in the future?
Well, I think it has been shifting. You look, there is no doubt, Amazon, I forget the latest numbers, but I think through their growth through the pandemic and the holiday season, I think they hired another 150,000 workers, and you think about the number of people that work at these fulfillment centers, it is a very labor intensive business. You cannot figure out how to put individual widgets in a box with the packing paper all automatically. You can move it around inside the box pretty efficiently, but labor has become a very big component of our business. We will not buy a site for development without doing a labor analytics study. Then when we start the development, we update it because it's now standard operating procedure for somebody on a site selection to want to look at the labor analytics study. How many bodies can they get within a 30-minute drive and what's it going to cost? And then there's the Amazon effect in the marketplace. There are people that don't want to be next to Amazon because, contrary to popular opinion, they pay really well. They were to abandon minimum wage years ago. They've increased their pay levels in the last couple of years. They have great benefits. They have great facilities. So if you're one of those logistics operators that isn't in that, same level of service and taking care of your customers, Amazon is very, very hard to compete with. So there are people that
I have wondered though, Jim, how much of the R&D budget is geared towards reducing labor over time.
Exactly.
Oh, they make no secret about it. Amazon sponsors a robotics competition every year. They bought what's the name of the little robotics that move the racks around. They bought the company. So yeah, no, they're all about trying to improve efficiency inside of that box.
So speaking of competitions and improving efficiency, we only have a few minutes to go here. So I do want to pause and realizing that a big portion of our audience are NYU students and presumably NYU students interested in coming into our space. Each of you has had a pretty spectacular career thus far with a lot ahead as well. What advice can we give these students about entering our industry, and what's the best piece of advice generally you've received? David, I'll start with you.
I was hoping you'd start with me. I think, the advice that I give to most people who are thinking about being in the industry is that they should think about the industry as, being one of the largest industries in the world. There's lots of ways to enter. And your career, I've had a very winding path to get to where I am. So, there's a lot of pressure on kids these days to be in this shop or that shop or whatever. There's many, many different paths within the real estate industry, and it's really what you make of it when you get there. The other advice I give is, wherever you go, make yourself indispensable to the people you work with, and good things will happen.
Connor?
One of the things that I've found helpful in my career is, don't shy away from really challenging projects. Typically, if you get given something that nobody else wants to do and you're successful at it, you can become known as sort of a fixer and get bigger and better projects going forward. So when you get your foot in a door somewhere, find yourself a mentor, find yourself the ability to don't be shy. And if you get given a project that's very, very challenging, there's very little downside risk because nobody else probably has figured it out. And so don't feel like there's sort of you're set up for failure. Just throw yourself at it and make sure that, give yourself a chance to succeed. And, also the other piece of it is don't shy away from sectors like retail that might be out of favor. Because in a lot of ways, if you're successful in a sector that's going through a transformation, again, you're in a position where you've been able to really learn something that's transformative and can take that to a number of different disciplines through in your future career.
On some level, those two pieces of advice were one and the same. Don't shy away from retail and embrace complexity. And Jim, you've had a career in industrial since long before it was quite as in vogue as it is today. So you must have the best advice for all of us.
Well, the advice I give young people today is so many people, when they talk about the real estate business, they think you're putting a yellow jacket on and selling houses or renting apartments. And to David's point, this industry is so big, and there are so many opportunities, public, private, all the different sectors, development, ownership, management, leasing, financing, all of those things. I would encourage you to jump in. Just jump in. Find a good company. As Conor said, find mentors, tackle challenges. Once you get in and get your feet on the ground, you'll figure out what you're good at and what you really like. None of us started, in the perfect spot with the right company, doing exactly what they loved. We got in, we had some people point us in the right direction. We must have done something right. And we evolved and we adapted. So that's my advice is, look, the real estate business is a great business. There are some sectors that have been beat up over the last year. Who cares? If you don't think the retail and the hotel business and the office sector is coming back, you are sadly mistaken, and you shouldn't be in the real estate business. They'll all come back. If you think urban cities aren't coming back, you're sadly mistaken. Jump in, get an opportunity, make good, and you'll be very, very successful. And there's a lot of money to be made and a lot of freedom and a lot of fun to be had in this business.
Wonderful. Thank you all so very much. It was so wonderful seeing all of you. Next year, hopefully all together in person.
We look forward to it. Thank you, Lauren.
Great job.
Thanks.
Lauren.
Thanks so much.